Per usual, everything on this channel is for educational purposes only, is not intended as financial advice. It's Macro Monday time. Let's start off with the usual institutional flows on the crypto side of things. Now, James has shared the same chart from CoinShares weekly. They changed it up this week. I don't know why. Doesn't really help me too much, but in any event, inflows 29 million denominated in Bitcoin. They say maybe this is because of inflation data, but yet most of the flows are coming from Canada and Switzerland. So I don't know if I buy that, but in any event, we are seeing minor inflows at the very least across the board, outflows for short Bitcoin as well. So we've been on a doomer fueled bender over the past couple weeks. I'm going to try my best this week to steelman the non-doomer side of the argument. I think it's important to actively seek out both sides of any argument, especially in trading. It's a game of probabilities. It's not a game about being right or wrong. So based on Trueflation, real-time estimate of US inflation, and in the UK as well, they have on here, I tend to think, in the US, we continue to look on the bullish side of things, at least year over year, if you're expecting inflation to come down. Now, if you've been to the grocery store, you know the prices are much higher than they were. That rate of change may not be increasing. You may also have noticed a rise in shrinkflation, where you're just paying the same for less. So despite what all of the VCs are currently touting that, we need to cut rates, we're killing the economy, tell that to Joe Public because they need some help right now. In any event, the real-time data looks pretty good. Are we fooling around still above 2%? Yes. Will the Fed need to eventually change their 2% target? Potentially, but I think that's years away, even if it ever happens. So I wouldn't just assume because the real-time inflation estimates are holding slightly above 2 that we'll just be happy with that. The recent CPI came in slightly up month over month, holding at around 3.2%. And look, over the past 3 months, over the past couple years, if we look at inflation estimates, we have seen progress, as they say at eToro here. Freights come down, rents come down, manufacturing prices have come down, consumer expectations of inflation have come down. Some housing data, it goes back and forth. We're going to talk a lot about housing today. Gas down, used car prices down, non-manufacturing prices down, commodities largely down. So many things have come down. Just from an anecdotal perspective, though, it certainly feels as though cost of living is still extremely high relative to pre-2020. And if we measure, it's called the misery index, inflation plus CPI, in many cities, they specifically point out Minneapolis here and not Baltimore, which is interesting, but from Bloomberg, looking at the misery index, the misery rate, there are some cities that are doing much better than others in regards to CPI and jobs. It feels as though we're in the doom and gloom territory, but we're still headed in the right direction. Things could be worse. Things could be much worse. And depending on where you are, things are getting better much quickly. Specifically, cities at the bottom of this misery index. And if we look at various measures of inflation, if we look at, again, do I know what prices only CPI is? No. Okay. But if the Fed's looking at it, if economists are looking at it, yeah, we're headed in the right direction. Things continue to decline. We are zeroing out the inflation data. What I really don't like about this is that we've changed how we measure inflation at the beginning of the year. We've gone from looking at a 2-year outlook to a year-over-year outlook. So we're no longer measuring the prior 2 years in the equation. And that certainly changes what things look like going forward. And, if we're looking at different data, different calculation, that's going to change, at least it should, change the mindset, but it won't. Everyone's just still focused on the headline number or the core or whatever else. Anyway, we're still headed in the right direction on that front. And then this research paper from the SF Fed came out about shelter inflation, saying that their year-over-year estimates could go negative. Now, we know the shelter component is super lagging in the CPI metric, 6 months-ish. So this should roll through CPI. The question is whether or not this will happen, obviously, whether or not this will offset the potential rises in energy costs that are bringing CPI higher. Don't know, but this is good news for the housing metrics within inflation. And then, as Andreas points out here, CPI less shelter quarter over quarter is zeroed out. It's effectively zero here if we take out the shelter component. I think another issue with the CPI calculation is we have kind of real-time numbers baked in with lagging multi-month numbers, and now we're all kind of forced to like make up our own equations and see where things are at. In any regard, this is a good thing. We're continuing to head in the right direction in that regard. One place where we're not headed in the right direction necessarily is the cost to rent versus cost to own on the housing side of things. And a big part of that, obviously, is the 30-year mortgage rates. This is from Tavi at Crescat, highest level in 23 years. And not only is that making houses effectively more expensive, or especially over the long term, but it's keeping supply out of the market, because if you've got a low rate, you don't want to sell your house for a higher rate. And so that's helping buoy prices as well on the housing side. So look, if you're a homeowner, if you already own your home, I think that's, 25% of people? There's a massive wealth effect here that's growing. So it's really good news for those people. For the people who don't own, it's obviously incredibly terrible news, because owning a home is getting farther and farther away from you, at least until prices come down. And, this is complete nightmare fuel. If you've got an adjustable rate mortgage, which I find hard to believe people actually have those anymore, but apparently that accounts for 6.5% of mortgages. So how are these people doing right now? I'd really love to see the stats on delinquencies of adjustable rate mortgages, but this is not the doomer video. This is the silver linings video. Signed rents declining, vacancy rates rising, and the apartment supply is rising. So this should help rents come down. This should help the inflation component come down, as it's showing here. This is echoing the SF Fed's data as well, showing that a large percentage of this CPI component should continue to decline. Vacancy rates going up. And we're building a ton of multifamily housing units. According to this, it looks like the most since 1975, 1970s. Now, this obviously comes down to location. Is this in cities? Is this a place where jobs are a livable wage? That sort of thing. That's a whole nother conversation. But at least in this regard, we're headed in the right direction. And if we look at percentage of owner-occupied houses by generation, Gen X and millennials obviously much lower in this regard relative to baby boomers. But over time, the inheritance will certainly get passed on to the next generation. And yes, this will further expand the have and have-nots, but eventually this will even out. Eventually, Gen X will acquire a great deal. I think it's the largest wealth transfer in history of wealth from the baby boomers. Again, certainly not everybody, but that is good news for you if you are Gen X or millennial. And used car prices have also continued to come down. I've been calling this, head and shoulders, right? If we look at fertilizer, there was a head and shoulders on fertilizer months ago. That's declined significantly. This is important for food costs, obviously. Now that excludes things like orange juice, olive oil, coffee. There was another one I'm forgetting, where those sectors were hit with disease or climate-related problems, causing prices to go up as supply came down significantly. So fertilizer not quite back to pre-pandemic levels on the index, but down significantly from highs. So that's very good news. And of course, I have to talk a little bit about the doomer fuel, which is this double dip inflation idea that happened in the 70s and 80s. And this, of course, is on everyone's mind. And I've seen this about 1,200 times on Twitter now. So you can't ignore this possibility. And maybe this is energy fueled, our next rise in inflation. I just have a very hard time believing that inflation will surpass the previous level of inflation. Maybe energy costs are out of control. Maybe stimmies come back. I don't know. But I have a hard time thinking about what may cause us to get there, looking at the current data and the direction of current data. So before we go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. And I was kind of looking around because this is the macro video, and I noticed that Kraken had a PAXG market, and for those of you who don't know, that is a stablecoin backed by gold held through Paxos with vaulted gold in London. You know, there's a lot, there's many counterparties, there's lots of issues and potential problems with this. Okay, this isn't perfect, but if you're looking for something that is able to be traded directly, this is an option. If you're looking at gold, long-term, short-term. I'm not endorsing PAXG, I'm just saying, look here, this is an option, right? And I was just looking at the chart saying, based on technicals for gold specifically, you know, there was a lot of hype in 2022 that all these central banks were buying gold, the price was declining. And then there was a lot of hype for gold, and it was back very near all-time highs. This is a multi-year triple top up here. But in the near term, this does look like it wants to flip bearish, at least on the bearish side of neutral in this range with an inverted cup and handle. You've got declining volume, not perfect. You know, this is a small market anyway on Kraken, but the chart pattern looks to be there. With an inverted cup and handle, you kind of want these two U's, which it typically looks like, and you don't want the second high to surpass 50% of the previous range. So it wouldn't surprise me if this breaks down somewhere 1800 is reasonable. There's also a potential for, you know, some sort of diagonal break going on here, very similar to the crypto side of things. But anyway, PAXG is the thing for those who aren't aware. And I was also curious comparing Tether Gold, Tether as a Gold XAUT, Spot, and then PAXG. I think what I'm calling Spot is actually not Spot, but at least on TradingView, it's called the Gold Spot Oanda. Anyway, they all track pretty closely. So that's also in the back of your mind. Obviously, if you're not buying gold directly and you're buying some derivative, is there massive tracking error? And there is a little bit, certainly with PAXG, but not much. So anyway, I'll leave this in the description if you're curious. Again, not an endorsement, plenty of issues with this, but it's there if you want to trade gold, you know? And if we look at the money supply, we've actually brought down the money supply quite a bit over the past year. Now, Lawrence is concerned that this may represent coming shotgun to the face. You know, look, we got to do something eventually. We can't just continually devalue our currency and let inflation go out of control. Historically, this suggests we are potentially headed for some trouble. And as he suggests, the Fed's going to need to pivot sooner rather than later. And we're certainly seeing many more media articles about a soft landing relative to a hard landing. And it's interesting that the consensus has flipped. We've gone from the end of last year where everyone was certain we were headed for a recession, and arguably businesses tightened their belt, figured it out, prevented that from happening. Whereas now the consensus appears to be soft landing. And according to Joe, you know, looking at this chart, if we look at soft landing headlines and Fed funds rates, soft landing headlines do typically peak just before or near cuts, right? Now, it's certainly not immediately the case in 08, but it's interesting how there even was a spike just before everything hit the fan in 08. So we are seeing a lot of chatter about soft landing. So wouldn't it be something if that didn't happen? But hey, this is the Silver Linings episode, so there's a lot of consensus around soft landing. And you know what? The 10-year yield, it's at 4.2%, historically extremely high levels, and that just says, look, you don't need to throw your money at risk anymore. You can throw your money into safe vehicles, money market funds, treasuries. This promotes the opposite of YOLO gambling. And real yields, which is the 10-year yield minus inflation, is the highest it's been in quite some time. And just maybe tangentially and anecdotally related, thinking about Sharpe ratios and how Sharpe ratios are calculated. Obviously, we all know cash isn't trash anymore, but I'm expecting Sharpe ratios to get crushed as the 10-year yield, you know, continues to rise, which just is another way of saying the risk-adjusted yield or the risk-adjusted rate continues to decline for everything, right? It just says, look, you're better off throwing your money into a yielding instrument. And it's interesting, if we look at stocks that pay a dividend versus don't pay a dividend. 100 of the S&P 500 stocks that don't pay a dividend up 20%, whereas the 100 highest yieldings are only up 3.2%. So I don't know if that's a yield growth versus value story, or if value is competing with the risk-free rate. I don't know, just interesting little tidbit there. And you can look at this in all sorts of different measurements. Cash just yields more than stocks. So this should help put a lid on, a ceiling on any crazy manias everywhere. The problem is, of course, because of our debt levels, we may need to start intervening. This is the 30-year yield over time here. Yuri and Timmer, of course, with the best multi-decade data from Fidelity, showing, look, we've broken out of this multi-decade channel on the 30-year. And with the amount of debt that we owe, this just isn't sustainable. And eventually we're going to need to step in. Now, I'm not going to explain yield curve control, YCC, something that Japan's done for quite some time. But if you're unfamiliar, definitely give that a look-see. But we may be headed there because, well, we're nearing $1 trillion on our interest payments. And I think most of those debt instruments the government is utilizing are near-term, short-dated, and not long-dated. So there is a refinance risk there. Eventually, in the nearer term, they will need to refinance. And if rates keep rising, that's just a continuous doom loop. But if we can try to reduce government spending, and look, I'm just trying to keep with the silver lining theme here. If we can reduce government spending, we can get this under control. But in the near term, it is out of control. There's just no way to put it other than that. And across the pond, as Talia again points out here, even though they're trying to roll off the balance sheet in the UK, there may be another issue here with the gilt market, failed debt auction, who's going to buy this, that sort of thing. So even with those easing measures, we're still back to where we were when the gilt crisis was happening. But on the corporate side, S&P 500 companies have locked in their debt until 2030. So this is arguably something that the US government should have done and could have done, issued a 50-year bond or something when rates were zero. Instead, we're focusing on the short-dated paper to pay for debt, which has a high yield, and we'll eventually have to roll that over into something else. But as the chart says here, nearly half of S&P 500 debt is fine until after 2030. Okay, so yes, the debt burden is high, but a lot of that debt is in no risk anytime soon. The debt burden, is minimal based on how this was financed in the ultra long term at that time. Switching gears to the DXY, which continues to show some strength. All this stuff is kind of related when we're talking about yields and debt and currency strength. And my concern on a TA perspective just continues to be rising above all these resistance levels and having another extremely bullish DXY or dollar index relative to world currencies. So I think the current prevailing argument is, look, the US is a relative safe haven compared to most everything else, and we're going to continue to see strength because as bad as things are here, it's much worse elsewhere, right? As Muhammad Al-Arian says, it's not just about higher yields. There's a super interesting thread from Bob Elliott about the PBOC potentially needing to intervene into the CNY and what they may need to sell in order to do that. And he goes into that down here. And there's another article from Bloomberg about hidden currency reserves. So we may not see mega DXY strength if the PBOC decides to step in and intervene here. But they're going to need to make that decision soon because we are at multi-year highs for the CNY, which continues to devalue against the USD, as does the ruble, as does UJ. On the right here is the Argentine peso, which is all the rage today, getting devalued 22% in a day. Egypt, to me, it looks like this is price fixed, but I could be wrong here. Again, you're seeing dollar strength pretty much everywhere. And the USD Euro chart essentially looks like the DXY chart, where it looks like we're about to break out from a strength perspective. So unless foreign holders decide to fight dollar strength, it certainly looks as though we should continue to see dollar strength in the near term. And as doomer as everyone is, if we look at a stress metric from the ECB, it looks like things are fine. Things are unbothered, moisturized. We're in our lane, okay? There's no issue here. So it's important to keep that in mind when we're expecting something to happen, expecting a crash tomorrow. We may see a spike, but as we sit here now, systemic stress is quite low. Let me just close out with some doomer remover on the credit card balances and auto loans, these are also at $1 trillion. I feel like everything's at $1 trillion these days. $1 trillion is the new billion. But we look at this number as in aggregate, obviously extremely high. But as Fisher Investments points out here, it doesn't necessarily mean everyone's tapped out. If we look at credit card debt relative to GDP, relative to personal income, it's actually near multi-decade lows and not that concerning based on this metric. And if you look at credit card debt against bank deposits, again, maybe not as doomerish as it appears. What I'm really concerned about, though, is what people are using credit cards for. Interesting article from Washington Post over the past week on higher income households are holding credit card debt longer. If we look at the year or more slice of the high income earners, 72% of high income earners households are holding credit card debt for a year, 27% more than 5 years. And with the rates what they are, 20% plus APYs, that's eventually going to come home to roost, right? And if we look at what credit cards are used for, a majority of that is emergency expenses. Me personally, I use my credit card for everything, so I don't know how exactly that gets baked into this data, because I think it's normal to use the credit card for bonus points and whatnot. But it looks like those on the lower end of the income spectrum are using it for day-to-day expenses and retail expenses, which over time will certainly add up. But in the moment, might not be so bad. Again, looking at delinquency rates, quite low. Doesn't seem to be an issue in the moment. So although many macro people have this enemy at the gate mentality, credit card loans might just be okay. Now, hopefully people aren't charging streaming costs and letting that accrue, because those are all set to increase or have increased on a year-over-year basis, which, to be fair, was expected. Especially when Disney Plus came out, no one assumed it was going to stay at $8. That was a competitive price point to encourage signups, but in any event, streaming is not getting any cheaper, that's for sure. As for the S&P here, looks like we are in summer vacation mode, much like Bitcoin, ETH in September. Equities volume tends to drop off in September. So I don't expect any mega bullishness anytime soon. If we look at the S&P, not much has changed. I think an eventual retest just under 44 is perfectly reasonable. Let the 200-day moving average catch up here. This doesn't look like it's going to crash anytime soon. It certainly doesn't look like it's going to reach for highs anytime soon. QQQ, same thing. Likely to give you a bearish TK cross this week on the cloud that may recross bullish in a future date, that may retrace through the cloud to 333. Very much a wait and see, but I don't think there's any rush from anybody to jump into the Magnificent Seven anytime super soon, even though we are seeing a lot of dip buying in the near term. So that's all for this one. It's not all doom and gloom, folks. There are some good data points out there that support things actually getting better. Dislike, comment, share, subscribe, and happy trading.